So let's get started. Building value to sell your business. The reason I wanted to talk about this topic is that a lot of our clients have been selling in the last year or so, and we've been lucky to be their valuation experts and the transaction advisory people. And by transaction advisory, I don't mean iBanker. I mean that we help them through the transaction process, through the transaction diligence, to assembling their materials, to have them ready for diligence, to make sure that everything is up to grade with what a buyer would expect. And we've interacted with the attorneys who are doing the transaction, and we've helped also with the investment bankers close the deal. Often we've helped select the investment banker and the attorneys who are working on the deal. So that has been a business that we've been doing for about 15, 20 years. It's a part of our firm's work. And overall, I think I've worked on 50 transactions, again, in that capacity as a transaction support and valuation experts. One of the things we do as deal terms change in the contracts or at an earlier stage, we help do a sensitivity analysis on what it means to the seller, what it means to our client. In all of those situations, we work for the sellers. So let's get started. And Teresa from our firm is helping me with this, and she's helping with the slides. And so Teresa, if we can go on to the next slide, please. All right, my goal is to help you prep your business for a sale. I want to also give you a sense of when and what expertise is necessary to get there. And then I want to share tips to build and grow value. Now, as I progress through this presentation, through the goals to try to help you in these areas, many other topics are going to come up. And in some, I can be helpful. Others, I will tell you who can be helpful. But generally speaking, because we've been involved in every aspect of these type of transactions, we've seen a lot of variations, a lot of issues. We've dealt with a lot of questions from sellers, from buyers, and we've seen a lot of contracts, a lot of letter of intents between buyers and sellers, and we've participated in negotiations throughout the process. So hopefully we'll hit in your questions will hit in one of those areas that I can readily answer. Next, please, Teresa. Yeah, so please stay until the end. We'll have live Q&A and an opportunity to schedule a 15-minute consultation, which I'd love to talk to you in person about your specific situation and how we can help. And so I hope that we can get to talk in person and schedule a time. Next, please, Teresa. Okay, so briefly on our firm, we've been around since 1992, so that's 30 years. We've been at this same headquarters, and that's the LA headquarters building here in West LA since 97. So that's quite a long time, 25 years. And what you see here is Tom Pastore and I sitting in the lobby, and to the right is a bigger picture of the lobby of our office in this building here. We're on the 8th floor, so it's one down from what you think is the top floor, and the top floor there is storage. Pictures are on the right-hand side, Forrest Vickery, who runs Sacramento, Jim Green, who runs San Diego, Genjo Sanley, my brother, who runs the Lagos, Nigeria operations, and Jay Bean, who runs the Brussels, Belgium, and Western Europe business. Genjo, my brother, runs Lagos, Nigeria, and any work we could have in Africa. And so that's us. We've been doing a lot of different work, as many of you know, business valuations, expert witness testimony, transaction advisory work, fairness opinions, solvency opinions. We've been doing that work for 30 years, and it's been a good ride for our firm. We've been fortunate to have great clients, great employees, and so it's been exciting. I still love to go to work every day, even though I've had the firm for 30 years and I've been working 6-7 years before that in the same field. It's just still a pleasure. Next, please, Teresa. All right, that's me. Basically, I've kind of told you everything that is on this slide. Let me see if I forgot something. Brand and IP valuations, yeah. And so I'm accredited as a senior business valuation appraiser. And we do a lot of forensic accounting for divorce cases where businesses need to be valued and assets need to be traced. Transfers have to be kept track of, and sometimes financial statements, income statements have to be reconstructed. Next, please, Teresa. All right, so let's talk about the basis of what we look at in typically valuing a business. We're going to look at identifying your gross margins of your business, and that is more for people who sell products than service firms. But many companies, many businesses incur a cost of goods sold, and the gross profit is what is left to pay all the other expenses of the business. And so that is an important factor to look at when valuing a business. Revenues, calculating sales, average sales price, the average sales multiplied by the number of items sold. Again, this is a measure for businesses that sell items, but we also have, for example, law firms, investment banks, and other type of service providers where we look at revenue generated by each individual to get to the total, and also to look at a ranking of the top performers and to determine their influence on the bottom line. And we've participated, for example, in the sale of large advertising agencies, large law firms, or other consulting firms, and the ranking of who is generating the most business, whether there's a concentration there, becomes important. For manufacturing, it's important to figure out how many widgets a business sells, how many cars a auto distributorship or dealership sells, how many TVs a TV manufacturer makes per year, and how many, and what's the total sales per item, gives you a sense of the unit revenues. And what is also interesting is that if there are different models of the same product, it's nice to have a breakdown by product of revenues, breakdown by geographical area, and a breakdown by other metrics that are relevant to understanding how a business works. Well, earnings before interest, taxes, depreciation, and amortization, otherwise known as EBITDA. Well, EBITDA is basically the most commonly used multiple or metrics to figure out the value of a business. It's the gross cash flow available before taxes and before interest, depreciation, and amortization. So let me break that down. Why is interest added? Because often buyers will bring in their own financing, and they have to look at the amount of funds that a business uses as interest to pay on, that is available to pay the debt they will bring on. Taxes. Well, the taxes can be different based on the status of the entity. Is it a C Corp? Is it an S Corp? Is it an LLC? And that will affect taxes. And it will depend also on which jurisdiction the operations are. So as a result, taxes are added because a buyer's structure and operations may have different geographical concentrations, different entity types, and a different level of taxation depending on the products that are sold in different jurisdictions. Depreciation. Depreciation is a non-tax deduction that is always added back, and so is amortization. Typically, depreciation is for the cost of equipment that you purchased, any capital expenditures a business makes, that is depreciated over time. Amortization is for amortizing the cost of an acquisition of another business, or the amortization of costs that can be capitalized. For example, the development and research put into new products. That cost typically cannot be fully deducted immediately in that 1-year income statement and has to be amortized over several years. Different type of acquisitions, different type of assets, different type of development cost and research are amortized along different schedules. Sometimes 5 years, sometimes 10 years, sometimes different amount of years. It's important to talk to your accountants about that if you have concerns. Typically, in a purchase and sale agreement, buyers and sellers have to agree on the purchase price allocation so that the buyer can figure out what amortization, depreciation schedules they're going to have, and the seller will be able to determine their capital gains based on that allocation. So it's important to know how these variables affect your planning into a transaction. All right, multiples. This is what we obtain by looking at past transactions of similar businesses. Where do we obtain that for privately held companies? From many databases we subscribe to and research into different areas where maybe the transaction was not reported to a database. Sometimes public companies acquire private companies that don't allow those transactions to be reported on a database, but we can find them on their public filings. And we're sometimes able to track down who was involved in the transaction, and we're able to have a conversation with a specific person that's willing to tell us what the multiple paid was, what the multiple that they used to EBITDA was, and what the ultimate purchase price was. So there are many ways to find transactions that are relevant to a valuation of a privately held business. And we know how to do that. We do it all the time. It helps because when we develop the EBITDA of the business that's applicable for the specific situation of the sale, we're able to then determine the value of the business. Now, I know I've said a lot here, but we'll go back to these topics as we go along in the presentation, but feel free to ask questions about these. By the way, there are other valuation methods that are used. In addition to an EBITDA multiple, we often look at a revenue multiple method. In addition to these, we look at the discounted cash flow. For example, recently, we valued 2 very fast-growing computer industry companies that are being sold to large public companies. We did a discounted cash flow in addition to the EBITDA multiple, and we also looked at the revenue multiple. Why have 3 methods? Just to kind of approach it from different angles, different point of views, and see what they yield. And then you can have a consensus valuation sometimes, or sometimes you put a weight on a certain method versus another one, more weight in one method as opposed to the second method. So when you are able to see 3 different methods that you approach differently, you're able to then get a broader picture of the overall value of the company, or what's the most likely value the company will fetch in the market. Next, please. Well, let's start with what the business is. The business is an organization. Organization has systems, has sometimes inventory, has financial records, has employees, has a history, has customers, many databases, many other intellectual property having to do with its product. It is important to organize all that. As you prepare for a sale, A buyer is going to look at everything you have in your business. Its history, its systems and procedures, its inventory, its books, its employees, its intellectual property, its equipment, its machinery, everything that makes up the business. Now, sometimes you'll have personal assets into the business. For example, you'll have a vintage jukebox in your office because you like it. Well, that most likely does not contribute to the value of the business, and it's something that's considered a personal property you brought to your business, and you usually take it home with you, and the buyer doesn't pay for that. Even if it's appreciated in value, it doesn't matter to the buyer, because generally speaking, that specific asset does not contribute to the business. There are many other examples of these, and so as a result, okay, I have a question that will answer. Are some methods more common in different industries than others? Well, it can be. I think that and I think I should answer that before we move to the next slide, but because we talked about valuation multiples just now. But there are some methods that can be more applicable in certain industries and sometimes at different stages of a business. Oftentimes, startup companies don't have revenues, therefore they don't have EBITDA. How do you value them? We usually do a discounted cash flow based on a business plan that is developed by the company, or a business plan we develop ourselves for the company, projections we develop ourselves for the company. So that's typically used more often for startups, but some startups are also valued on what another startup sold for recently in the same space. And then that's entirely based on the metric used. So no revenues, has been around so many years, but it has eyeballs from websites, website visits. It has a lot of metrics from website activity, and often the valuation will be based on that. So yes, the question is, some industries may require different valuation multiples, and at different stages, businesses can be valued differently. Yes. And so all of those assets we just talked about in the organization are going to be reviewed by a buyer. And they're going to go through it line by line, very carefully. They'll ask a lot of questions, a lot of support. For example, on the financial statements, they will say, okay, I want to see all of the bank ledgers. I want to see all your bank statements and your internal ledgers. Why? Well, they want to make sure that from the bank statements, they can tie in the deposits with the revenues shown on the internal ledgers and on the financial statements. They want to also make sure all the expenses tie in, because they're looking at the profit of a business, how much cash is left. And in there, they're going to want to see how much was going to the shareholders, to the owners, to compensation of management. And a buyer will want to make sure that they have a good handle in all of that history of information for several years. So your bank statements for all of the accounts owned by the business, your ledgers, internal ledgers, where you enter all of your payments, all your revenues, and they will look at your financial statements and the tax returns of the business. They all have to tie in. It has to be like a serial process by which all of them tie in. Now, can there be differences? Yes. Why? Because the financial statements can be on an accrued basis. So then we look at accounts receivable, accounts payable to adjust the difference. Whereas your ledger will be on a cash basis. And your bank statements are on a cash basis. And so those need to be understood. The differences have to be understood, reconciled, but everything needs to be very well organized to prepare to a buyer. Now, I'm showing you organized as if I'm showing files, but the organization has to be available in electronic data warehouses, Dropbox, and other names like that, or other companies like that, where it can be easily made available for sharing during the diligence process to the parties. Now, Some companies have old systems. If you're planning on selling, you want to have updated systems. Large buyers like private equity firms or strategic buyers want you to be in an electronic updated system so they can plug you into their overall company system. Now that can require some translation time, different software, different computer language, etc., may require adjustments and translations. Not all of that needs to be done at one point or another. Also, list of all your equipment, the list of your computers, the list of your licenses on the software and all your computers. Also, your corporate status. Are you in good status with the state in which all the states in which you're incorporated? Are all your licenses current? Is your IP registered? Are all of your other information updated across the board for all licensing, registration, certification, state, etc., etc.? All of that is going to matter. List of all your equipments, the status they're under, the repair bills on the equipment. I can tell you something, equipment that has required a lot of repairs, far more so recently than in the past, is probably time to replace before a sale, because those become negotiation items in a transaction. Next, Teresa, please. All right. Lou, I saw your question. I'm going to answer it later because we're moving on a little bit, but we'll discuss it. Now, branding, very important, even more so now than ever before. The branding part of your business will probably gain more value. The brands you have gain more value than the operations of your business. What does that mean? Well, your brand multiple, let's say we separate the brand of a business from its operation. You set up a separate company, you move your brand there, and you pay royalties to yourself, let's say an LLC, and that LLC is called My Company's Brands. And the company where you're operating from is called My Operations, Inc. All right, that's where you have all your employees, you pay all your salaries, you manufacture, you own all the equipment, etc. Now, the branding is in My Brand's entity. That My Brand's entity only receives royalty income and is shielded from the liabilities of the operating company, the manufacturing company, or the service company. Well, what kind of liabilities does a service company have? Product liability, employee liability, officers and directors liability, accident liability, workers' comp, name it, tax liability, etc. There can be many liabilities that come with an operating entity. Why? Because there are people, machinery, equipment, location, products, deliveries, and all of that create liabilities. So when you separate them into a branding company, you automatically pay every month a percentage of your revenues as a royalty to the branding company. That royalty company's multiples, once it's established and your company is doing well, that multiple for the branding company can be a multiple that is 50% to several 100% more than the operating company's multiple. Why? Because brands collect royalty with no cost and no liabilities associated with it, or very little cost associated with it. Much more valuable, no liabilities, and it's usually a coupon. You collect it every year, every month on a percentage of revenues generated without the liabilities. So let's keep that in mind. Refine your messaging and your brand, whether it's advertising or the name of the company, captures your audience. Pepsi or Coke, McDonald's, Wendy's. It captures the audience. The more refined, the better someone can visualize the brand. That helps you retain customers, retain clients, Sometimes it's different. Customers typically used for retail businesses, clients are used for services and other type of businesses. But it helps you capture your audience and also helps you ultimately create a culture for your company. The image of your company is often associated with your brand, with the name of the company, and also the name of your brand. Let's move to the next, please. Work culture. And a part of branding is also your work culture. The goal here, when you prepare your company for sale, you want to leave your business in the hands of people who have worked with you for a long time, loyal, enthusiastic, diligent, and self-sufficient staff. Buyers, when paying for a business, want to make sure that the people that make that business happen are going to be around for a while. Even the owners of the business, the seller, are often asked to stay as CEO for a couple of years, 3 years under an employment contract, sometimes under a bite the apple twice concept. Instead of selling 100%, you sell 80%. You stay on board as the CEO, and after 3 years or 4 years or 5 years, whatever is agreed, you're bought out at a different multiple or at the same multiple, but at a much higher level of revenue or EBITDA, depending how we set the formula for the second buyout of your shares. The first buyout is on the 80%. The second buyout is 3, 4, 5 years later. And that can be a different formula, or it can be the same multiple. Let's say that you sold at a 7 times EBITDA and your company was doing 10 million EBITDA when you sold the first time. 3 years down the line or 4 years down the line, you grew the EBITDA to 15 million. If you use the same multiple, that's your second bite at the apple, and you can make a nice additional payment. Next, please, Teresa. Okay, so this is really important. Valuation is in everyone's mind when you sell the business. It's in the seller's mind, how much money can I get? It's in the buyer's mind, it's in the investment banker's mind, it's in the mind of your accountants for calculating your capital gains. It's in the mind of the buyer for figuring out how they're going to amortize and depreciate what they buy from you. Valuation is essential. Also, as you prepare to sell, it's important that you understand your valuation before getting into an iBanking process, meaning a sale process with an intermediary. For example, you hire an investment banker or you hire a business broker, depending on the size of your business. Before that, you want to have an understanding of what your business may be worth, at least a range, which we do that all the time, provide an early range, so that you can see where you're going to be after tax once you sell the company. Depending on your industry, depending on the size of your business and your profitability, these questions become even more important. Industries with large buyers, strategics, and large private equity buyers that do roll-ups, for example, or buy a lot of businesses geographically, will want to have a good understanding of valuations and of your expectations right out of the gate, because they're not going to waste their time. There are large organizations that move a lot of people on a transaction. They put a lot of people to work on a transaction. They don't want to waste their time. So it's good you know your value. It's good they get a good sense of valuation. It's good that everyone that's involved in the sale process is very well aware of where you're going. No point starting a valuation process, or no point starting a sale process without knowing where you stand on value. So we worked on a situation not too long ago where the company got one valuation, and the attorneys then and accountants looked at it and they said, look, yeah, I think we should get another opinion. So we got involved. One of the parties referred us and we got hired. And we determined that the valuation should be higher. And so we determined that there were some things that could have been researched better, and we found more multiples, more activity in the industry, more transactions. So why did we find all this data, and why didn't this other valuation find? Well, it has to do a little bit with size. We work on about 200 matters a year, 200 different assignments a year. So we can afford to amortize the cost of all of these databases and all of this research, both in terms of labor and in terms of subscriptions across many, many matters. A small firm doing 20, 30, 40 valuations a year cannot afford to. It just does not make sense economically. Because also, if you're smaller, you charge a little less because that's one of your competitive advantages. Well, there is only so much you can do. So in that situation, we determined that the client's business could sell for more. And at the end of the day, it sold for a little bit higher than our valuation because a competitive process was started. The competitive process of buyers was started by the investment banks. And that's an important aspect of a transaction we'll talk about more. Let me see, I think I have another question. All right, that's Teresa, next, please. And so let's get into the details. This was a well-established business. Two owners were in conflict, and they didn't trust each other anymore, and they were angry at each other and were in litigation. So they got a business valuation to assist with the shareholder buyout. One of the two shareholders was asked to leave. The shareholder in command of the business was continuing and wanted to buy out the shareholder that left. This was a minority shareholder, and the client needed to buy him out. It was a he, and the buyout would have probably resulted in a discount for lack of control and marketability of a minority show, probably. Now, they decide to hire us for that purpose. And they had run the business and founded it together, ran it with no sale in mind because it was going well, and they never organized a lot of the things they should have organized. They weren't keeping track of things. And they had some divisions that were pet projects that they enjoyed having, but they weren't tracking, so they didn't know how it worked. And sometimes people engage in many activities in a business, and they often convince themselves that 5, 6 different divisions they have all contribute to each other, and they all make up a whole that works well. Oftentimes, if historically profitability has been good, no one wants to rock the boat. No one wants to look into these things. And so when we got hired, we started looking at all of the aspects of the business, because one of the ways they could buy each other out, or the shareholder that was staying could buy the expelled shareholder out, was either to find a partner to pay for some of the cost of buyout, or find a strategic buyer, or maybe they had to sell the whole business, because as multiples kept going up, 6, 7, 8, 9, it gets harder and harder for an individual who has had a business for a very long time to have the amount of cash required to do a 7 times, 8 times, 9 times multiple buyout. Historically, way back when, multiples were 3, 4, 5. It was easier for you to put down for one of the owners to pay some of it as a down payment, and then carry on and borrow the rest from a bank. But when the multiples are so high, banks lend less than on an EBITDA multiple basis. So for example, it's 7 times, 8 times multiple of EBITDA for the total value. A bank will only lend 2 times. Well, the buyer now has to find 5 times EBITDA themselves to finance the transaction, to complete the transaction. The higher the EBITDA multiple, the buyer has to capitalize themselves out of earnings or out of friends, family, and fools' money, the less likely that transaction is going to happen. Was there a buyout agreement within the ownership agreement? Yes, there was a buyout. It had a clause that was written that discounts should be applicable, but it wasn't so clearly stated that it could not be litigated. So there was an agreement, but often these agreements are written when no one is thinking about a conflict, about a buyout. Often they're written when the company is starting and everyone says, we'll deal with that later if we get there. And so, yes, but the agreement was not clear enough to provide a proper buy-sell mechanism so that this could be effectuated in a very nice way. And so as a result, the litigation started. And as a result, one party said, this is subject to discounts or lack of control and marketability for a minority share. And the minority owner who had left the firm said, look, you're misusing funds, you're overpaying yourself, you're not distributing enough profits, and my share should not be discounted. So that's a typical battle that occurs because agreements are not written with all these possibilities in mind. So we recommended that the company organize its business systems and procedures, that they create an HR manual, they retain an investment banker, they improve their customer database and develop better customer outreach, and also look at the profitability of each division they had, each silo within the company. They were under the impression that all of them contributed to one whole and made the whole place better. Well, we found out that there was very little cross-selling between the divisions. It was negligible. It wasn't worth the headache, especially that as we looked at the ratio analysis and we implemented these measurements for each division and asked that cost allocations be performed across the divisions, they realized that some of these were not doing well, and it was better to sell them to improve the profitability of the business or shut them down entirely. What is important is that if you believe there is cross-selling, you need to make sure that it actually occurs. And you need to make sure that it does create profits. Oftentimes with small companies, people who buy one of your products, especially with service firms, if you want to sell them another product, well, aren't I already paying for that by paying for product A? Why do I have to pay so much? Shouldn't I get a discount, etc.? So when you factor all that out, cross-selling within a small organization doesn't always work well, especially if your products are differentiated enough that you think they're different, but the buyers are reluctant to pay sometimes twice in their mind. So as the company implemented this, and it took a while to implement it, all these procedures, strategies, all focused on increasing value, are at creating a stronger environment for employees and for customers and for buyers when they started diligence to check all the boxes that it's there. HR manual, it's there. Life insurance for the seller, it's there. Profit sharing plan, it's there. Employment practices liability insurance, it's there. And go down the list, check all the boxes. Unprofitable divisions, out. So all of those boxes need to be checked. And so this new organization, after about a year or so, almost 2 years, as I recall, it was profit driven and had proven systems, made the business more appealing, and in turn, both owners decide to sell. Now, you're going to say, well, this costs a lot of money. Yes, because they had to put accounting teams, IT systems, database management, brought in HR consultant to develop the manual. Yeah, they spent about $100,000 total on this, maybe a little more. But at the end of the day, that's a one-time expense. So it's an add back to your EBITDA. It's not going to be repeated every 2-3 years. A lot less, it will cost to maintain it, but it's a one-time expense. So whatever money you invest in your business that is solely meant to upgrade the business for selling purposes, you may end up getting 5, 6, 7, 8 times multiple for it. Because if the multiple for selling your business is 7 times, you spend $1 million improving your business to get there, and we add that back after a year. That's a $7 million increase in the value. So it is a little bit like a house. Tenant improvements, additions increase the value of your house. Business improvements add value to your business. Next, please. All right. So I have a question for you guys. What are some key factors business owners should avoid or consider when buying or selling? Any questions? So I have one. What do we do with competition? I haven't talked about competition. Well, it's good to consider historical competition that's been around for a long time, but also new competition coming into the industry, because a buyer is going to look into that. So you want to be ready to answer the question of, what are you doing about this new competition coming in your business? For example, your logo was manufactured in the USA. Well, now everyone is producing the same product in China, and it is affecting your margins. What have you been doing about it? Another question asked by Mark Fowler, and thank you all for your questions, and also Lou DeVos, shareholder history. Well, first of all, shareholder history is important. You want to know if there were any buyouts of past shareholders. Also, you want to have their curriculum vitae, the history of the shareholders with the business in terms of age, experience. Were they the original founders, or are they a second generation owners, or second generation family members? And you want to understand their position in the firm, whether they're active or not. Typically, the less active our shareholders in the business, the more valuable the business. Again, the less active our shareholders in the business, the more valuable the business. Why? Because that means it's run by professional management. People who may have a minority interest. People who may have stock options. Public companies are rarely run by majority shareholders. Every one of us that owns shares in public companies are minority shareholders. Management owns tiny fraction of the business, no matter how rich they get out of being active in it. They own a tiny percentage because they're professional managers. They get paid based on performance, or are supposed to, or would like to in the best environment. Question, can you talk about selling your business but keeping the land you operate on? Yes. You can. Often private equity buyers, strategic buyers don't want to buy real estate. They're in the business of buying a business. So it is better to separate the real estate from the business, own it under a separate entity, and pay yourself rent every month. Give it a long lease or a short-term lease with renewal options. But it is always better to separate. The EBITDA multiple on a business may be substantially higher than the cap rate on your property, on your real estate, or vice versa. Either way, I always recommend people to separate them all. If a buyer wants both, that can be discussed, but separate them all. Always better. Now, since we talked about this discounted cash flows, and Lou, you asked earlier a question, what do I think about discounted cash flows for startup businesses? Well, discounted cash flows are as good as the data that's put in there. And so you need to be very diligent at developing projections that are that have good foundation, that are well sourced, that are explained by other businesses in the industry who are generating revenues, by looking at the models of people who have generated revenues in the industry, so that you can hook your hat on to facts that make the projections reliable, or at least reasonably understandable. And you want to make sure that for startups, your discount rate for your discounted cash flow is very high. The higher the discounted cash flow rate, the lower the value. So you capture the inherent risk of not achieving those projections by having a high discount rate. Projections are just what they are, projections, but they are done all the time. Everyone does projections. In any business, you need projections, but they cannot be achieved. There are substantial risks that cannot be predicted. That's why you increase your cap rate or your discount rate. You increase your discount rate to reflect all those risks. Calculating a discount rate that's applicable to a specific situation is an art in itself. It takes a lot of time, a lot of research, and we use a variety of databases that calculate additional risk for different types of investments since 1929. And that enables us to get to a point where the discount rate is high enough. We also have discount rate on venture capital deals or internal rates of returns that we convert to discount rates. We also have transactions that we looked at from a variety of companies that were startups that were sold and what discount rates were applied. And so we're able to those projections. So we're able to get pretty close, but the key is not that those numbers at the top, revenues or EBITDA, are going to be achieved. The key is to assess the proper risk on those projections to reflect that many of those things won't happen the way they're described. Am I making sense? Oh, okay. George Sugarman asks a very good question. What about owners who have secrets or embarrassing, or embarrassing details they are reluctant to share? Could be cash sales, side deals, kickbacks from suppliers. When should this information be divulged? Right away, immediately. In fact, that's how you also hire a valuation firm to prepare for this. What we do is we explain that there were some of these problems in the past, but they have been corrected because advisors told the company that this is not good business practice. They've corrected those, and that all of that is now properly reported, properly calculated. Everything coming out now as early as possible buys so much comfort in any buyer. That is so important. Anything that's hidden to the 11th hour will blow up a deal, and it will come out because these people that are multimillionaires, billionaires, or huge corporations, they'll find out. That's why they are so rich, they are so successful, they're so big, because they don't make a lot of mistakes. They will make some, but they don't make a lot of mistakes, especially in acquiring companies. They will find out. You're the one who's going to get hurt by hiding. Do not hide anything. Everything should be divulged. Past litigation, potential litigation, bad behavior that happened and what was done about it. People that were terminated that became competitors. All of that should be brought in, discussed, presented, because honesty buys you so much in this process. Dorian Curry has a question. Yes, everyone is saying yes. Dorian Curry, Michael Pfizer. Michael Pfizer is a great M&A transaction attorney, corporate attorney. He's been down this path before, has seen it before, and yes. Dorian Curry is a financial advisor, wealth advisor, very successful. Know him well, know both of them well. They say yes too. These are one of the best practices. These are great questions. Chris, Henry, your question, yes. Some advisors may tell you differently. The majority of the people I deal with, the majority of the advisors I deal with about separating the real estate from the business will tell you that that's the way to go. But there may be other reasons why it can be done, and that's a separate conversation. It's very specific. There's some new messages here. Let me get. In your case, was ESOP considered? Not in this situation. I've had other cases where ESOPs were considered, and I work with clients that put together ESOPs. It could be a good formula. They're hard to pull together, but it can work, and I've seen many of them being done. So, especially if you have a lot of employees that are likely to stay, or a lot of professionals, like a civil engineering firm, perfect candidate for an ESOP. Also, the more employees, the better. The smaller, the less likely. But recently, I've seen a small ESOP of a professional consulting firm with about 6, 7 employees, 8 employees, and they were able to do it. All professionals, so it's possible. Well, Michael Pfizer adds a nice legal disclaimer, and I agree with that. It's talk to your legal counsel on this. All right. Next question or next slide. Thanks, Teresa. All right, the jack of too many trades. This is a little bit of the example I mentioned earlier about the company that did not look carefully about its divisions, but on a different space. This was a pretty well-known influencer, motivational speaker, had many ways of advertising, generating revenues. And, nowadays you can become an influencer with so many different things and get income from a variety of sources, like from Twitter and YouTube and all those places. And in this instance, they were really misapplying their funds. They were continuing to nurture areas that did not get a good return on investment. So as part of our analysis, we determined which divisions they were putting too much money in and that weren't getting a return on them. One thing is to shut down what's not working. The other thing is to continue to invest in something that you want it to work no matter what, and one day you think it's going to work. And the other thing is to invest in something that has worked in many places and you know it can work. It is hard to differentiate those, and sometimes it takes the experience of somebody like me and my people here who have worked on dozens of matters, dozens of situations, and have seen many things work and many things not work. And we're able to compare, benchmark, share with you experiences without naming anyone. Even if you're their competitors, we often don't talk about your competitors, anything they're doing, if we were hired by them. But we are able to share a lot of wisdom, industry experience, data that helps you prioritize what's best for your company. Next, please. Okay, so this is the result of what happened. Revenues went up 25%, profits went up 60% because there was a lot of fixed costs. It all went down to the bottom line. And the minority interest owner was purchased here. Next, please. Okay. What do you think of this question? You know, I'm going to move on, and I'll let the questions come in, and we'll discuss them as they come. Next, please, Teresa. Okay. So this is a company that repairs textile, and they've built immense value in this space. Like companies that buy large swaths of textile, they need to do quality control on them, and sometimes they need minor repairs so that they can still be used. And so we work with them for over 10 years, and we advise the owners that the creation of stock plans to keep employees on was great. So it could be incentive stock option plans. This was in like incentive stock options. We also assisted them in figuring out what's the fair royalty rate for their brand, because they had developed proprietary repair processes. And so we told them to separate that put that into a separate entity, which is what I mentioned earlier, so that they can pay royalties. They also franchise this at a local level so people can use their systems and procedures to repair fabrics. We also told them that that IP holding company and franchising company only would fetch a larger multiple than the operating companies. So it's good to separate them, and do not put operating companies in the entity that franchises the IP. So at the end, they were able to sell everything, and we assisted in forecasting their model, their growth, the future cash flows, the EBITDA. We looked at how natural disasters would affect their fabric business, whether their customers were at risk of not being able to function, and we tried to incorporate as many risks as possible. And we also looked at the fair market compensation of the owners once they would be replaced by executives when they sell the business. And this is a common problem. Founders, shareholders of business, family members get overpaid in salaries and W-2s, often so that they pay less taxes that ends up accumulating for the year end, or because they're C Corp and then they pay taxes twice. And so this is something that we deal with all the time, and we do a lot of compensation studies, and we've done one here. Next, please. All right, good question here. Well, I guess that's a self-compliment. Didn't mean it that way, but it's a good question. That if we know that two businesses next door to each other are not the same. You can have two restaurants next to each other. There could be two Italian restaurants next to each other, pretty much selling almost the same thing, but different name, different ownership, perhaps different cost structure. The leases may be very different. One may have had a lease that's just renewed and the cost went up, and the other one has a 30-year lease. Or one of them owns the real estate, the other one has leases, perpetual leases, or leases that need to be renewed with substantial cost adjustments. That would affect the profitability. That would affect the operations of the business. The one that owns the property may not be paying rent to themselves and can afford to pay their employees more, can afford better quality food ingredients, better wines, can afford to stock more wines. So all of those things will affect two businesses being next door to each other. And it's the same across the board. Two manufacturers of widgets will have completely different financials, cultures, branding, customers, And sometimes two people that manufacture the same product are selling to, or visually similar or similar in use, but are selling to different tranches of the customers. One sells to very high-end customers, the other one sells to low-end customers. Cars, why are car malls all together? Auto centers, because you have Volvo, you have Porsche, you have Audi, Hyundai, and Toyota. Different customers, different buyers, different worlds. So when looking at this issue, I'm going to give you a sense. We need to look at different comparable transactions, and we need to adjust the multiples to reflect higher profitability. A business that has higher EBITDA margin to revenue will have a higher multiple. A business that's growing faster will have a higher multiple, EBITDA multiple, than the same business growing slower. So all of those factors need to be considered. I have a question. Is it appropriate to address that despite valuations, the willing buyer, willing seller kicks in? Yes. Willing buyer, willing seller always kicks in when you have a transaction. And the price may be higher than the valuation or lower. It will depend on a lot of factors. But the valuation will give you a guideline. We're saying, look, the most likely buyer or the average price it would sell for is, let's say, 10 million. And I'm the first one to say, look, it could sell for 11, for 12, it could sell for 8, 9. And I think we've found all the skeletons and disclosed them all. But if there's something out there that you even don't know, to the seller, I say this, and a buyer finds out, it may reduce the price to 7 million. On the other hand, we can have the private equity buyer who is absolutely in love with your product and will buy it no matter what, and will pay 17 million or 15. Look at sports teams. It's a hobby buy. You're super rich, it's not a big deal, and you want the Lakers. Or you want that football team. Why? Because you want to own a team, because it's been your passion all your life. There are things that are not included in the fair market value concept. Fair market value concept is willing buyer, willing seller, both parties fully apprised of all facts that could affect the value either way. Neither one of them under compulsion to sell or buy. And it's an average price, the most likely price, the average price. So when you have that situation in there, we can include things like somebody who's going to pay 25 times EBITDA, or that somebody is going to find that there is a real problem with your factory, or that a buyer is going to say, well, the city is not going to allow a new buyer to come in without doing ADA compliance across the board. Things we didn't find out. That one we usually find out, but something that a buyer discovers that could affect the value. I'll give you an example. Client is selling, parties agreed on the purchase price at $14 million, private equity firm and our client. The seller, through diligence, finds out that about half the shop employees, on the ground at the warehouse, distribution, and some manufacturing, were illegal. And the buyer said, look, this is huge. This is a huge liability. It's going to cost us $2 million at least. And we can't do this. So we want to reduce the price down by 2 million. Well, I mean, on the face of it, that sounds right. But I asked the lawyers, because I had seen this situation before. I asked the lawyers representing the seller, to bring in their lawyer, their labor attorney, to determine whether there was that kind of exposure. And they determined there wasn't that much exposure, that it was not a big deal, that it wasn't what the buyer was claiming. And the seller said, look, I'm going to fire them all. I'm going to replace them, train the replacement, and sell to you at the same time. We're going to close the same time. You can come and check, it'll work. And so that conversation was mute then. So those issues come up and you need to deal with them. Can you address the topic of buying or selling a business with multiple jurisdictions? Yes. That often requires to have attorneys with experience within each jurisdiction, each state, each country, in order to close the transaction in each of those jurisdictions. Sometimes you have a business that operates on dozens of properties, some leased, some that they own. And upon the sale, the leases have to be transferred and the properties may have to be sold or new leases written. The laws for transferring a lease, for selling a property, escrow procedures, all of those are different in every state. I've seen it a lot. And overseas, it's the biggest nightmare because then we have language barriers as well. And so all of that needs to be dealt with separate counsel in each of those areas. Also, the company's position can be very different in different jurisdictions. In some places, they could be a monopoly, which are allowed in some countries. In other places, intense competition. Multiples may need to be adjusted based on different jurisdictions for that specific subsidiary. Different employment contracts. Here, we don't have employment contracts. In Europe, most countries, everyone has an employment contract. In other places, there are no employment contracts, but you can't fire anyone. Other places, some factories, maybe union, others not, in some other jurisdictions. All of those require a huge amount of diligence work and research. Next, please. All right, well, we got some time left and I hope we can answer some questions. And we have about 15 minutes, so please shoot. I'd like to answer as much of your questions as I can. Teresa, we can put individual microphones if you raise your hand, or we can do it via chat. Oh, okay, here are questions. What if I am a minority stakeholder and okay with selling the business, but not interested in signing a non-compete because I want to remain in the same industry type of business? Well, it's going to be hard to do that because the only time you have a shareholder, a non-compete that can be enforced is when you sell shares in a company you own. Now, you can perhaps, if it's location specific, not sign for California, but be able to open in Nevada, or you can open maybe in Texas. You can do geographic sometimes on a variety of different things, different products, different, different aspects of the business. So in here, you're saying you don't want to sign a non-compete. Well, if you're my minority owner, I'm going to pay you money for your minority shares. I'm going to want a non-compete. I can't advise any of my clients that if they want to buy out a shareholder, to agree that they can compete with them unless they buy them for a substantial discount to the fair market value of those shares. Doesn't matter that if all the professionals in a service-based business, such as marketing and web design, are contractors, 1099s, and the business does have more than one or two employees. Does this evaluate the business more or less? Look, the fact that there are 1099s may not impact the business. We have clients who have, for example, large amount of truck drivers, and currently they're all on 1099. That law may change, but not yet. And so that does not change the thing because that's the business model. It is okay to have a business model where you rent employees. It is okay to have a business model when you bring in teams of people together, as long as it's part of a going concern and it's part of a system that works. And that when a buyer looks at them, they're going to say, yeah, it works. So if it works, why change it? Now, a buyer is going to look at the looming possibility that your contractors may have to become W-2 employees, or if they want to expand the business, they're going to look at what happens in other jurisdictions. The fact that a business have more than 1 or 2 key employees is good. The more spread number of employees that are key, the better it is. Do you believe innovating in evaluations and method is necessary for the upcoming digital decade? Look, we've been doing digital valuations for 20 plus years. You know, companies and software technology. We're using the historical same methodologies that have been applied to different metrics, different ways of looking at what a business means in technology or in digital world or with Bitcoin and all that. Typically, ultimately, about the value of a business is dependent on return on investment. And that's the same concept no matter what you deal with. And so, yes, methods develop, methods open, but not always. I mean, it's just a part of the business. Okay, well, thank you, everyone. Thanks for joining. Thanks for attending. Thanks for your great questions. I really appreciate it.